I had this idea back in 2025. We finally executed it on 2026. And here's what I wanted to do. I wanted to create content that was 8 to 12 minutes long. And it was truly speaking to the originator, the real estate agent, and the home buyer at home about real stories that happen in the real world with real loan originators. If we were soldiers, these would be our war stories. But unlike war that is catastrophic and sad and destructive, this is the exact opposite. These are stories where we found a way to yes, where there's a lesson to be learned, to where homeownership was made attainable and affordable and even possible. We call this Talk Mortgage to Me. It is a new piece of content that we've recently introduced, and today you're in for a treat because you're going to get to sample 3 of the Talk Mortgage to Me segments with 3 different top producers who I'm friends with that absolutely crush it in the industry. And they're going to share a real story with you about real scenarios, how they found a way to yes, how they help someone become a homeowner, and how they achieve success at the highest, most elite level. You get to listen, you get to watch, you get to learn, and leave feeling motivated to go out and do your job at the highest level. Check this out. They don't teach this shit in school, but they should. Welcome to the Loan Officer Podcast, hosted by me, Dustin Owen, one of the most influential people in the mortgage industry, along with my friends who've lived it, built it, failed at it, fixed it, and scaled it. This is not a show just for mortgage professionals. This is everything I learned because I became a mortgage loan originator. This is the Loan Officer Podcast. Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and, well, just me, just Dustin Owen, because this is a super unique, never done before special episode of the Loan Officer Podcast. We are going to feature, highlight, share with you some content that we've been creating and we have been putting up on YouTube once a week for most of 2026. These short stories that you're about to enjoy are me sitting down with some of my friends in the industry. I have Mike Smalley, I have Christine Wilson, and Jason Purcell. All 3 are loan originators and sales leaders I personally would work for. All 3 have 20 plus years experience in this industry, and all 3 absolutely crush it in the mortgage industry. Collectively, they have funded billions of dollars of production. They have helped thousands of families become homeowners, and they're partnered with some of the best real estate professionals and home builders in their markets. First up, we have Mike Smalley. Mike and I sat down recently, and he went through specific scenarios that he is currently working on in his business. And he's going to teach you exactly how he turned a no into a yes simply by adjusting the length of the term on a loan that he was originating. It went from the loan makes no sense to, oh my goodness, I can't wait to sign on the dotted line. First up, Mike Smalley. Check this out. Mike, you were telling me that you wanted to talk about a recent family that you helped, but you helped them on a refinance, not a purchase.
Yep.
And you actually put them into a 20-year loan instead of a 30-year loan.
Yeah.
Walk us through that scenario.
So I think, we're coming into a season with interest rates drifting lower, and most people who purchased a house between 2022 and 2025 are hoping to refinance, when it's feasible, when rates are at a low enough number. And what I found over the years is when people refinance a 30-year fixed to another 30-year fixed, they're going backwards in time. You might be 4 years into a 30-year and you're going back to another 30-year. And so yes, your monthly payment's going down because your rate's lower, but part of your monthly payment going down is you're stretching it back. And if you run kind of an amortization schedule of how much interest you're paying over the next, let's say 3, 5, 10 years, it's not as big of a savings as you think. So what we encourage people to do is look at doing a shorter term. And I found that a 15-year loan is likely going to be a significant bump in your payment. And people can't always afford going from like a 30-year that they're 2 years in down to a 15-year. That 13 years is oftentimes too much.
Because what you found is that their mortgage payment actually goes up. It doesn't go down.
And they're paying that increase is all principal. But if you can't afford, to go from $2,500 to $3,500, why would you do that?
Correct. No one wants to be house poor.
Right. So what we found is, if you go from let's say a 30-year loan that you're 2 years in, so 28 years left, if you go from 28 down to 20, with rates dropping a point to maybe 1.5 points, 2 points, for over the last couple of years where they spiked, you can in many cases keep your payment almost the exact same. So it's not a payment reduction strategy. It's keep my payment the same, but knock off 5, 7, 8, 9 years worth of term. And if you kind of run an amortization schedule out, the amount of equity you build, how accelerate it for the same monthly payment is pretty significant. We've also noticed that the difference in rate between a 30 and a 20 year is changing. So for many years, a 30-year fixed and a 20-year fixed was almost the exact same interest rate. For the past couple months, that gap has widened, and so we're seeing people that could get a 30-year, let's say at 6, a 20-year at 5.625. It was always 30 to 15 that would drop your rate, but now you're seeing a big rate drop from 30 to 20. So yeah, most of the clients that we had, and we've got hundreds that have bought homes with us the last couple of years that are hoping to refinance at some point when rates hit like a target. Most of them were running schedules on a 20-year amortization, not a 30, and the play is not payment reduction, keep the payment the same, just pay the house off a lot faster with the same payment.
Have you recently helped a person with that type of refinance?
Sure. Yeah.
So kind of walk me through that scenario. Like what did they do for a living? What was their house worth? What was their income like? Like without using specifics, like we don't need first name, last name, social security number. But
yeah, so I've got two, and one actually is choosing to do a 30-year. So I've got one that has 7.3 or so.
Is their current interest
bought
rate?
The house, yeah, and they can get into like the upper 5s range, low 6s. So I recommended a 20-year because we could have done a 20-year, knocked off 9 years of term. Their payment was going to go up about $25 a month. But what I didn't realize is this person has a significant other. So a couple own this house. They're young, in their 20s, but they have a roommate or two.
Okay.
And the roommate or two are paying rent. The roommate or two are going to move out at some point because these two are probably getting married at some point. And when that happens, the roommate's out, that, let's say, $500 a month of rent that's coming in goes away. So one person was like, you know what, Mike, I get it, but when my roommate moves out, I would actually like the lower monthly payment.
Correct, because they want to be able to afford the home.
Right, and so it becomes kind of a payment scenario. So for that person,
yeah,
it was
you're taking them from 7.375 down to
6%, 5.99.
Okay.
They're only going backwards 1 year because they just did it a year ago, but they're going from 29 years left back to 30, but reducing their payment by like $400 a month.
Yeah.
But another person, that same scenario, like 7% to 5.625, knocking off 8 years worth of term, $50 a month payment increase. But $50 a month is $600 a year. They're building like $5,000 a year more in equity. So
wow.
We did a video the other day and we said, if it costs you $3,500 in 5 years to save $30,000 in equity, does that math make sense? Of course it makes sense.
Yes.
But you have to be able to afford the $3,500 increase in your payment, which was like $50 a month, or $60 a month, over 5 years.
Yeah, that second scenario, they're not getting cash flow rich,
right,
but they're getting equity rich.
Yeah.
Yeah. Very cool.
Yep.
Mike, if people want to get a hold of you because maybe they have a refinance scenario they'd love to run by you, what's the best way to reach you?
Sure. I'm always available on my phone. So 407-367-9190 is my best number.
Yep. Email is michael.smalley@ccm.com. And if y'all have any other real estate or mortgage needs, you can also look at the link in the comments below, fill out the questionnaire, and we can have someone like Mike reach out to you to answer any of your questions if reaching out to Mike wasn't what was the best decision for you to make.
TLOP Unite is not your typical mortgage event. This is the first ever TLOP cruise experience built exclusively for originators. And for 4 days, it's not about the speakers, it's about you. We're talking breakout strategy sessions, real conversations, curated events, and uninterrupted access to a community that helps you grow. If you're serious about taking your career to the next level, this is where you need to be. Space is limited and the price is right. So click the link now and learn more.
How about a round of applause for my guy, Mike? Not many people know this, but Mike and I were actually business partners for 17 years. He is one of the best originators I've personally ever had a chance to work with, and I'm honored to call him a friend. I love that tactic of just reducing the loan term, not 30 years, not 15 years, but sliding into a 20-year term on the refinance made it make sense. I've had other friends in this industry lower someone's term from 30 years down to 25, and they went from getting a refer to an approve eligible. Mike Smalley and his team, they 100% know how to find a way to yes. Now, next up with the mortgage firm is my friend Christine Wilson. We call her Chris. Chris is an amazing coach herself. She is a phenomenal originator and a great leader. And Chris is going to walk us through how getting creative with varying down payments is sometimes the difference of someone being a true mortgage advisor or just an order taker. And I'm going to tell you a little secret you're going to learn by listening and watching Chris is this: loan advisors become top producers. Order takers, well, for the most part, average to below average. In this, you're going to learn, be like Chris. So Chris, walk us through the first buyer that comes to mind that you've recently helped, who thought that he or she had to put 20% down. You ended up being able to educate them that they didn't. What did that situation sound like? What did that transaction look like?
So he was he had been divorced for a couple of years, had a great job, but it was kind of wasn't cash heavy.
Okay.
You know, just out of a divorce, he was, but he still had his 401k, still had a big chunk of money in his 401k. And so he came to me and he said, I'm going to take the money. I'm going to take 20% out of my 401k. And I was like, and he's like.
Which you can borrow against your 401k. Well, at least most 401ks allow people to borrow against them to use for down payment and closing costs.
Yes.
But you were like,
well, and it also depends on the age.
Yes.
For me, when I think about, I'm all for borrowing against your 401k. I did it when I bought my first house, but it depends on your age. Once you get past like 40 into the 50 range, I kind of like, that money is for your retirement.
Yeah.
That money is not for saving up for a house. So this guy was definitely, he was in his 50s. And he was wanting to take 20% out of his 401k. And I was like, have you talked to your financial advisor? I said, because I don't think he or she is going to be a big fan of this. And he was like, nope, that's what I want to do. They come to you with the 20%ers that want to avoid mortgage insurance. They think mortgage insurance is like the evil of all evilness.
I have a neighbor that reminds me of this guy. And my neighbor's a great guy. He makes really good money. But he's a DIYer, right? Do it yourself.
Yeah.
He wants to do everything himself. I'm like, well, hey, there are like professionals who actually have done this, I don't know, 2,000 and 3,000 times throughout their career.
Yeah.
You've maybe done it once or twice throughout your career, and maybe there's other perspectives and points of view.
Yes.
So you have a 50-year-old who just went through a divorce, right? So I'm sure that wasn't a fun event, both emotionally and financially. Mm-hmm. So a lot of his liquidity was probably wiped out. Mm-hmm. Still had his 401k, so that was preserved. But this guy's been out of college for 20 years, 30 years. He's making good money. What do you think he's making? $150, $200 around there?
Like $150.
Yeah. So probably making $150,000, $200,000. If you're in Orlando, Florida, he's probably an engineer, more making that type of money. Mm-hmm. And at which point, yes, he knows, right? I know what I'm doing. But what were you able to show him?
Well, I just showed them options. You show them, they come in ablazing with the 20%. But if you show them that the mortgage insurance is really not the root of all evil, it is the savior. It allows you, because guess what? Cash is still king and will always be king. And so keeping cash in your bank accounts is the smart thing to do. It's not, us loan originators, it's not that we want the loan amount to be bigger. We don't want you to, it's just that we want you to be financially sound after you do this, because I always say, once you put this money into the real estate bank account vault with a very humongous door, and it's very tough to get that money back out of real estate. It's not cash anymore. Now it's in this real estate vault that you have to either get a home equity line of credit to get that money out, if you can,
if you qualify,
if you're able to, or do a cash out refinance. Again, if you're able to, if you have the equity in.
Or sell your property,
or sell it,
which
That's
could
the third
take
option.
6 months,
Yes.
and then also cost you $30,000 or $40,000.
Correct. Yes, and real estate fees. So it's so important to consider pulling money back if you can afford the payment. Now, some people don't want that payment. They want to put down the money because of it. But I think also, too, they don't realize that when they keep, another $25,000 to $30,000 in the bank, how that makes you feel psychologically.
It's called the sleep good at night factor.
Yes.
Like, I sleep good at night knowing I have $30,000 in my savings account. Yes.
And you make great decisions when you have money in the bank. And when you don't have money in the bank, you make desperate decisions.
So let's look at this guy's scenario. Roundabout, what was his purchase price?
Oh, he was because he was just trying to get into house, and I think it was like $350.
Cool.
Yeah.
So $350,000, right? And this guy's probably newly single.
Yeah.
Based on where he was in life, maybe his kids, if he had kids, were out of the house. So for him, finding a 3-bedroom, 2-bath townhome was probably the perfect size home for him. So he could find that in Central Florida for $350,000.
Yep.
20% would have been $70,000 plus another $10,000 for closing costs. So he would have been out of pocket roughly $80,000. What did he end up putting down?
10%.
He put down 10%. So he put down $35,000. So instead of out of pocket being 80, now he's out of pocket closer to, I'm guessing, somewhere around 43,000.
Yep.
What was the difference in payment between the 10% down payment and the 20% down payment? And then how much did mortgage insurance add to it?
Yeah, I think his mortgage insurance was only because if you have great credit scores and your debt to income ratio is pretty decent, then the mortgage insurance can be really affordable. And I think it was it was like 50, 60 bucks.
Yep.
It was really not that much money. And so once he saw that he was able to not, and 401ks are making, average usually right now around
8 to 10%. Yeah.
And so when I showed him, hey, if your 401k is making 8%, let's just call it 7 on a bad day. Let's call it 7, and the interest rate's at 6. Then why are we pulling so much money out of this? And I think he just really, it was a light bulb moment for him going, oh yeah, why am I doing that? It's just these old things, these stories that we've been told on how evil mortgage insurance is. And it's not that evil. It actually allows you, it's a tool that allows you to keep your money in your bank account and have that sleep good at night feeling.
Yeah, because by him putting down 10% instead of 20% on a $350,000 property, you're probably looking at about $200 in principal and interest, right? His payment was $200 higher, but this is somebody who makes $150, $160 a year, didn't have a whole lot of debt, so he wasn't overly payment sensitive.
No.
The MI added another 50 or 60.
Yeah.
So yeah, what makes more sense? Keeping that $35,000 in your 401k working for you. By the way, that money compounds, right?
Right.
So it's 7% on $35,000 this year, but it's 7% on $38,000 next year. It's 7% on $43,000 the year after. Whereas people might not understand this, your mortgage payment, right? We know this as professionals. It's an amortized payment. So that means you have more principal being paid off next year, more principal paid off the year after. It's almost working in reverse of the compound interest. It's like, yes, why not leverage when you can leverage, especially when it makes the most financial sense? And I promise you, as somebody who like Chris, worked 20 plus years in production, the extra $300 a month that I would make by you borrowing more, the extra $300 in commission I would make because of you borrowing more, that's not what I'm doing this for. I'm doing this because it's what's right. And if I do what's right, the odds of you referring me go up. The odds of you coming back to me for another home loan go up. That's what business I'm in. I'm in the business of referrals, not how do I squeeze an extra $300 in commission out of this person. You said you had another scenario that was similar where you leveraged mortgage insurance because it was the right move, where maybe the person coming to you thought they had to put 20% down. Do you remember those details?
Well, I just had a review. It was like this long on our website, and it was just
A Google review or a Zillow review?
Well, it was Experience, which is
Okay,
what we use, and I think it went to Google. But
Okay.
anyhow, and it was really interesting because I actually got this referral from Reddit. I have a Reddit thread out there.
Good for you.
Oh my gosh.
You've made it.
It is amazing. I mean, man, I don't communicate on Reddit. I'm not on there very often, but man, do people believe in this Reddit thread? And it's unsolicited, and so you can't force that. But anyhow, they came off of there. Again, we just went through with them, is a younger couple, first time home buyers, went through all the scenarios, super detail oriented individuals. And so when I have those individuals, it's even more important to make sure that they have all the data in order to process, because they want it all. They want all the data. So we just went through all of they ended up putting 15% down instead of 20% down. That was just their choice. And it worked out well. And they were just so happy, and they were very just at ease. And one of the things that you just said that made me think is, no, I don't want you to call me 6 months from now and ask me for a home equity line of credit. I don't want to do business with you again for another year or 2 or 3 or 5.
Yeah.
I don't want to do business. I want to put you in a loan that you feel great in for the next 3 to 5 years. Refer me your friends and family, but no, I don't want to do business with you unless you're going to move or do something else that was uninspected. But I want to put you in something that you feel comfortable in for a long time.
Yeah, it sounds like that scenario was a perfect case example where someone could have put 20% down, but if they did, then they would be what I call house poor, meaning they don't have any money left over, right?
Oh.
There's no emergency fund. There's nothing to pay for new furniture. There's now they're really sacrificing.
Yes.
Where you can show them, even on a $600,000 purchase, that 5% is $30,000. Oh,
Yep.
no, it's not $30,000. That 5% is $15,000. Right? But how do you sleep better at night? Knowing you have 15 grand in your bank account, or knowing that your monthly payment is $100 less per month? For most of us, I'll speak for myself here, I sleep better knowing I have that extra 15 grand in my bank account. The $100 a month, I guess if I couldn't make that payment, I can go to my bank account.
Right.
Right? 15 plus, no, 15, 100 times.
Yes.
Right? I could keep going and going and going in order to get money out if I couldn't. How many months is that? How many years is that?
Not to mention, we make more money as we go along.
Oh,
You know?
yes. Well, correct. Yeah. Our money is growing
Yeah.
when it's sitting in that investment account. And then more importantly, with putting 15% down, you're paying the cheapest mortgage insurance. So
Very inexpensive.
So
yeah.
where your divorced 50-year-old engineer may have been paying $60, this person may be paying literally $30.
Yeah, it was like $38.
$30 in mortgage insurance.
Yeah.
And lastly, y'all, for conventional loans, you can get your mortgage insurance removed. Right? Do a year or 2 of making on-time payments, let your home go up in value, pay down your principal, reach out to your servicer. It is very possible to have your mortgage insurance removed, at which point that extra money you were paying, whether it's $30 a month or $70 a month, even that was temporary. Chris, thank you for sharing these 2 examples with us, and more importantly, educating our TLOP audience. If people want to get a hold of you, what's the best way to reach you?
I would just Google me at Christine Wilson at the mortgage firm. I typically come right up, and all my information's there, and a call to the office or email.
Perfect. Christine Wilson, branch manager, producing branch manager, Central Florida market for the mortgage firm, licensed though in many states. Check her out, reach out to her. If you sound like someone who thinks 20% is needed for down payment, but you ain't got it, guess what? Christine can show you ways to buy homes with little to no money down.
Loan officers, if 2026 is going to be your breakout year, this matters. Most originators don't struggle because of rates. They struggle because they don't have systems, structure, or accountability. I'm Coach Christy with TLOP's Originator Coaching. Originator Launch is a 16-week small group coaching program designed to help you build a real business, not just close the next loan. You'll get weekly live coaching, proven scripts used by top producers, real accountability, homework that actually moves the needle, and 2 private one-on-one calls with your coach. This program is capped at just 10 originators, so the attention is personal and the results are real. This isn't a course you watch. It's coaching you execute. If you're ready to stop guessing and start building with intention, apply now. Spots are limited, and once they're gone, enrollment closes. Register today.
How about a big whoop whoop and a couple snaps for our girl Christine with the mortgage firm? I'll tell you this, personally, I remember buying my last house. I had a chance to put 20% down, and if I did, it'd probably take all the little bit of money I had saved up, or I could put 10% down, take a slightly higher interest rate, and elect to go with a one-time lender-paid mortgage insurance. You know what was the best thing for me? That 10% down option, slightly higher rate, and lender-paid mortgage insurance. I learned that from men and women like Christine in my market who were originating at a high level. When I saw what they were doing, I incorporated that best practice into my personal practice. This is something all of us can get better at. Observe, swipe, adapt, and constantly level up. Now, next up is Jason Purcell. Jason and I have had to compete against each other. We have collaborated with each other. There was one time we even discussed trying to work together. He's an amazing student to this game that we call mortgage loan origination. He's a phenomenal sales leader and one heck of a producer. Jason's going to walk us through one of those scenarios that makes your head spin, and many originators would have just given up. But when you have the tenacity of a Jason Purcell and you have that type of loan volume on the line and that much real estate commissions that you're trying to save, what you'll learn is that you have to use your brain, leverage your resources, and find a way to yes. Check this out.
Jason, you have another scenario you want to share with us where the audience can listen to how you found a way to yes and find ways to be encouraged that home loan financing is available, especially if they're working with the right lender. Walk us through your most recent scenario.
Yeah, we got a call actually this summer. I was at my daughter's volleyball at the Orange County Convention Center, and it was a May Day. It was supposed to close on Friday. Actually, that was the day that I was receiving this phone call, for example. I stepped out, took a little bit of information, but I had a self-employed borrower. They had 3 businesses, they had 3 investment properties, they had their current primary residence, and then they were buying my agent's listing. And so they came with the financing, so I didn't get the opportunity for that one. And they were working with a loan officer that they've closed 3 transactions with already. And then as he's talking through, I said, you just can't do you can't do what
you're trying to do
based on the loan officer's advice. And so a lot of times when tax returns aren't going to work, we look at bank statements. And so typically we can help them qualify with 12 or 24 months of their business banking deposits. And that is a way, if they don't have the taxable value, to get more income for qualifying purposes.
Yeah, so the way that I heard and understood this story, and by the way, you said Mayday. Okay, Mayday, 911, fire, hot potato, emergency, like something went sideways because this particular buyer was already working with a lender that they had experience with. Like, they had done 3 transactions with. They had no reason not to trust this guy or this girl, and I'm sure that lender is a great lender. However, sometimes things don't go the way you expect them. So you're at your daughter's volleyball tournament and you get that phone call, and the phone call isn't from the buyer, right? The phone call is from the person representing the seller. Because what does the seller want? They want to sell their house, get their money, and a lot of times they're buying another property.
Yes.
And if their home doesn't sell, it impacts them being able to buy their next property, or maybe they're just trying to go away on a European cruise for 45 days, and this is the money that they were planning on using because maybe the dude just retired. Whatever the case may be, it's never good when a seller can't get their money.
Yeah.
And it's Friday night, you pick up the phone call, and your realtor's like, Jason, I need your help. And you get on the phone, and by the way, y'all, as lenders, just so you know, when we hear self-employed, we take a deep breath, we take a step back, and we pause. Because a lot of times with our self-employed clients, they're able to take advantage of every tax code out there, and the taxable income doesn't represent the revenue that they're generating and the money that's going into their bank account. So when that happens, we historically turn to a bank statement loan. I think that's what you were saying.
Yes.
And your go-to, and maybe that other loan officer's go-to, was, hey, let's look at a bank statement loan. The problem is you couldn't do a bank statement loan. You're going to talk to us about why you couldn't do a bank statement loan, but real quick, for those that don't know, a bank statement loan is essentially when a lender looks at 12 months of your business bank statements, and they look at all of the deposits coming in over those 12 months. And based on those deposits, they're able to come up with and formulate a qualifying income. And more times than not, that qualifying income is much higher than what you're showing on your actual personal tax return. But you couldn't go bank statement loan because what happened?
And this would have been a slam dunk if we could have used business bank statements. But unfortunately, the business partner was basically commingling personal funds into this account. And there were 9 NSFs the previous month to me getting this loan introduced to me.
Yeah, so in general, when you're doing a bank statement loan, that bank statement is a business bank statement, and all of the transactions, the debits, the credits, the comings and goings, need to be for business purposes.
Yes.
The minute a mortgage underwriter starts seeing that you're using your business banking for personal use, like, you know, you're paying your mortgage with it, or you're paying your kids' tuition with it, then all of a sudden it's deemed commingled assets. And for many lenders, that negates that account from being able to be used, right? And then on top of it, an NSF, non-sufficient funds, is terrible. Like back in the day, it would have been like bouncing a check. You're trying to take out money that's not there. So although typically it would have been a slam dunk to be able to say, you know what, ma'am or sir, you don't qualify for conventional financing because you had the 3 rental properties and maybe they're showing a loss on paper. And you had the 3 businesses and maybe they're not showing sufficient income on paper, but you have enough money coming into your business, we can formulate income based on those deposits, except, wait a minute, there's a business partner and the business partner is commingling them with his personal debits, and by the way, he's over withdrawing, right? It's like, we can't do this. But what loan did you do?
We ended up switching it to a profit and loss loan, also called a P&L loan, and that's where we can take the P&L, we can take the P, the profit, and that's what we can use in lieu of bank statements or in lieu of tax returns, for example. And that was tough, but we weren't asking the CPA to do anything that they hadn't already done because they had the 2024 draft prepared. They just weren't filing the 2024 on the business because of what was going on. And so we were able to do the profit and loss. The CPA was reluctant to sign, and this is not an audited financial. I said, put on there, this is not an audited financial, and you're just signing what was given to you. And again, it matched the tax returns that will be filed, and we were able to get that done. But again, the CPA initially was reluctant to do that because of their code. And again, that is just another solution that we have. And so if tax returns don't work, we immediately look at bank statements. And if bank statements don't work, then we're going to look at a profit and loss.
So what I'm hearing is when there's a will, there's a way. In this scenario, the loan was funding in 2025, you would have needed 2024 tax returns. However, the tax returns weren't filed yet. Probably the person had filed an extension. Mm-hmm. So in lieu of getting that 2024 tax return, you can get a profit and loss statement. But a lot of times, if you're a self-employed person, your CPA will tell you this, CPAs may feel a little bit uneasy having a profit and loss statement going to a lender, but as long as the CPA can write on that profit and loss statement that this is not an audited financial statement, it should give the CPA the peace of mind that they need, that these numbers haven't been audited, meaning the taxes haven't been finalized, but they are utilizing the information given to them by the business owner as it pertains to this is how much revenue we generated the previous year, these are what our expenses were. And there are specific loan programs out there called P&L loans or profit and loss loans where it's different than a bank statement, but it solves the same problem that a bank statement does, which is doing loans for self-employed people can be difficult because a lot of small business owners or self-employed people take full advantage of the U.S. tax code, which is great because they're not paying a lot of money in personal income taxes, but it's bad because they don't have a lot of taxable income to show to a lender to qualify for conventional financing or FHA financing or VA financing.
And the terms on these loans are very favorable because they are putting 20% or more down. And ironically, it looks like I may be doing another loan to buy that partner out.
What typically, I'm not going to hold you to it because mortgage guidelines change on the daily, but typically, what type of minimum FICO are you looking for and your minimum down payment are you looking for these types of P&L loans?
Yeah, typically you're going to be 680 plus credit score. A lot of times you're going to be 10% or 20% down, for example, and those rates technically are going to be in the upper sixes right now.
Okay, so like to give you all some perspective, as Jason and I record this, the average interest rate is sitting right around 6.3%.
Yeah.
So yes, this is alternative financing. Yes, it comes with more risk, but it's not a punitive hit because maybe you're looking at 6.8 versus 6.3, but you're not staring down the barrel of something that's 8.5% when the market's yielding 6.
That is correct.
Jason, if people want to get a hold of you, what's the best way to reach Jason Purcell if they have a scenario like this that they want you to help them with?
You can call me at 407-383-8884. You can email me at jason@cmpfl.com, or you can follow me at Jason R. Purcell on Instagram.
If you're a licensed originator who's closing loans, but you're not consistent, this is for you. If you're brand new or just looking for motivation, trust me, this is not for you. Most LOs don't need more information. They need structure. They need proven processes and somebody to hold them accountable. T-Lob's Originator Coaching gives you weekly live coaching, scripts top producers actually use, and step-by-step business systems you can implement immediately. Not someday, we're talking day one. You're not watching videos alone. You're executing in real time with other originators who take this seriously. Right now, you can try it free for 2 weeks. That's 2 full weeks for free. You'll sit in on live coaching calls. You'll get access to the frameworks and see exactly how top producers run their business. If it creates clarity, if it creates momentum, or even if it puts wins on the board, you keep going. If it doesn't, no worries, you can cancel. No pressure at all. Click the link, start the 2-week trial, and finally, build this like a business, not a side hustle.
Well, we've clapped our hands, we snapped our fingers. I guess for Jason, let's stomp our feet. Jay, way to crush it. Way to find a way to yes. I got to admit, back in my hardcore originating days, I don't know if I would have had the fortitude that Jason did to get that deal done, but what a great lesson to be learned. Way to find a way to yes. The segments talk mortgage to me. I originally did it as a way to teach and coach your buyers and your referral partners, but here's what I'm learning. Mortgage originators, you too can and should be learning from these top producers that I'm featuring on these segments because they're giving you real life scenarios and real life stories from the trenches that not only encourage you to get out there and do your job at a high level, but it also may teach you a thing or two about programs, products, guidelines, and more specifically, finding a way to yes. If you like this content that we just shared with you, I need to let you know it's only available on YouTube. We currently do not make this available on the audio only format. So you have to go to our YouTube channel and you have to subscribe. What you're looking for is Talk Mortgage to Me. It's one of the various additional types of content that we create on top of the DO show, Coach's Corner, and Mortgage School. Finally, if you're a mortgage originator and you're looking for more resources like this, one of the resources that you may love is our T-Lob's Originator Coaching Community. It's the #1 value in business coaching and sales training in the entire industry. And I have great news. You can come check it out for free. Go to our website, tloponline.com. That's TLOP online.com. And on that website, when you go to coaching, you can sign up for a free 14-day trial and see everything that you're missing because you're currently not a part of our coaching community. Thanks for tuning in. I appreciate you letting me get a little bit creative with you today. Keep checking in, keep tuning back. Our more regularly scheduled programming will commence shortly. For now, this is me, Dustin Owen, saying goodbye.